Hey, what's up, guys? This Kensmoneymatters once again. Be back as usual with a new video. I hope you guys are liking, subscribing, sharing, and asking questions, commenting if you can. We're going to be looking at bonds as usual. I love bonds. I always say that, right? But I know right now I did a video recently that said, hey, you need to be careful, right? So I need to give you all perspectives, right? So there are still people who want to invest in bonds, and that's fine. I give you all perspectives. You make the decision. I don't make the decision for you. So don't say, oh, Ken said, this is just me helping you make a decision, not me making the decision for you. But if you want me to help you make a decision personally on an individual basis, then you know where to find me at kensmoneymatters.com. Anyways, today we're going to be looking at bond, the latest ones that were released, and actually the sale has closed. I was waiting for the sale to close because I wanted to go through the bond and kind of give people a real picture of what you expect from the bonds. Because again, with the changing economic environment, with the changing returns, you want to be sure of what you're getting, not just what is advertised, but what your real return would be. That's a very important bit. You need to know what your real return on that investment would be. And the main question here is it really worth it at the moment? So yeah, we go through the bond, we look at the details, and then we answer the question if it's worth investing at this particular time, or if you should be waiting for other opportunities, other bonds, or trying to buy something else, not debt security related because of the interest rates right now. Anyways, as usual here at Kensmoneymatters, talk about the money mindset, how to make that money, how to enjoy that money, how to manage that money, how to invest that money, and how to assure yourself of a lifetime of income. Basically, financial freedom. Let's go. And guys, please subscribe, like these videos. This is important information. It's critical information. It can help you, shape your future financially speaking. So share with your friends, your family. Make sure you're supporting us as much as you can, because that's the only way we can ensure that everyone has this information, which is critical to their financial success. Okay, guys. So I'm gonna go on to my screen. I'm gonna show you the bonds on offer, the ones that have been closed just recently, and we're going to discuss the details of these bonds. We're going to look at the real return once we're done discussing that, and I will tell you exactly what to expect as a return on these bonds, because you know what? It's not as it seems always. It is not as it seems always. Okay, let's go. Okay, so guys, looking at my screen right now, we're looking at the latest offer. Like I told you, you can always find these bonds in the CBK website. Make sure you're on the right one, the centralbank.go.ke, so that you're actually on the right website. I'm looking at the bonds that were offered. These were reopened bonds, meaning that they had been opened before at a different time, and now they are reopening these bonds again for people to buy. So we are looking at the prospectus for reopened 15, 20, and 25-year fixed coupon treasury bonds. So there's not infrastructure bonds, these are fixed coupon treasury bond. What does that tell you? Before I even say anything, for those who have been watching Kensmoneymatters for a long time, it means it's taxable. Okay, cool. So fixed coupon bonds. Let's look at the different bonds, right? There was the fixed coupon bond number 1. That is for 15 years. Then we have one for 25 years and one for 20 years. Okay. That is the tenure of these bonds. But of course, because they are reopened bonds, you can see this was in 2022. So it's done 3 years so far. That puts it at 12 years to maturity. Okay. So when you're buying this bond, just be aware that, if you bought it, be aware that it's 12 years to maturity and not just 15 years. Sometimes people miss that bit. And then the 25-year one is 22.5 years to maturity. And then the 20-year one is 7.6 years to maturity. That's the tenure of the bond. Depending on what you're comfortable with, it's very important that you're comfortable with a very specific amount, with a very specific duration in which you're going to lock your money. Because remember, with bonds, you're going to be locking your money. So you have to be aware that your money is going to be locked for that period of time, unless you end up selling it in the secondary market, which is not advisable. The coupon rates of these bonds for the 15-year one is 13.9%, okay, which is basically 14%, right? For the 25-year one is 14.1%, obviously, because you are locking your money for longer, taking higher risk, you get just 1% more, right? And then you have the 20-year one at 12% exactly, which is interesting because the 15-year one would be, okay, I guess it depends on the subscription rate, right? Most people seem to want something in the middle. They feel like 20, 25 is too high. Maybe 15 is like good enough. Maybe these people listen to Kensmoneymatters. So people who subscribe to this 15-year bond knows that, hey, right now I need to be a bit more careful. Let's not go in too long, You never know. The proceeds may change in the next 15 years, we could be at 20% per annum, and then you're stuck with this bond here. Anyways, guys, so we have around 14%, generally speaking, on average. Again, in this case, from a a risk perspective, then the 15-year one would make more sense, unless you want to go for 25-year one. So let's go to withholding tax. I did say that this is taxable, so that's going to be 10% as usual. Maturity dates, they have there, no issues. Sorry, the period for sale was between 16th of April to 30th of April. So this also closed already. People are already invested, and they've done their settlement with the bank, and everything is good now, settled. Then we have the other one, which is the 20-year one, is between 16th of April to 7th of May, which was basically, that was yesterday. When is today? Let's see. Today's 8th of May. So yeah, that was yesterday actually. So the settlement date is actually 12th, which is Monday usually. Yeah, cool. The auction date, that's nothing we want to care about right now. But the amount for the first two was 50 billion and 30 billion. So that's fine. Non-competitive is 53,000 minimum. That's fine. The rest are just normal details of the bond. Now, if you come down here to the pricing tables, right, we have the clean price, and usually we have the clean and the dirty price. So here they've given us the clean price. And if you hear clean price, it just means it does not include the accrued interest on that bond. And then the dirty price will include the accrued interest. So clean price and dirty price in bond prices is just, the accrued interest. So if you come down here, they even tell you that, hey, the bond attracts an accrued interest of 0.5362 per 100 Kenya shillings. Withholding tax is computed on the clean prices, meaning before the accrued interest. That's where they apply the withholding tax. So if the quoted yield is 13.9%, the dirty price is the clean price, which is 99.9, and then you add the accrued interest, which is 0.5362, and gives you 100.5197. Easy peasy. That's the difference. Anyway, you have the clean price and the dirty price here, and you can always calculate what you're going to get. Okay, now let's go to this one. Let's go to the results that were released yesterday. So this is the one that I wanted to focus on mainly. This is the 20-year one. This is the one that was closed yesterday. So as you can see, the total amount that was offered was 30 billion, and people bid at 54 billion. That's the number of bids that they received on this particular bond. And the performance rate was 181.29%, meaning it was oversubscribed by 81%, a whooping 81%. A lot of people are looking for this bond. It's also interesting at this time. It could be because people are running away from stocks because of what's happening. I'm quite surprised at that. I'm also surprised because then the returns are not as great, but a lot of people seems to be going into bonds. Anyway, the money also could be from institutions that don't want to keep cash. Maybe they've been holding cash. So many reasons could actually drive this. Something I need to analyze in the next video. So the market weighted average was obviously 13.6, which is higher than what we saw last time in the last bond, which was around 13.2. So a bit of like an increase, a bit of like, an improvement in the interest rate, but not as good still. Most people would not really like that. 13 point something is still low compared to what we've had, but still very comfortable, guys. Still very comfortable rate for any investment that you don't take, you take minimal risks. Anyways, 13.6, that was the market weighted average. The price per 100 at average yield is at 92. This is the bond that was offered and it's been closed yesterday. These are the details of this bond. Let me know in the comment section if you bought it. Let me know if you invest in bonds and if it's something you like. Let me know what you think. Now, let's go into the real question of this video, which is, at this rate and with these particular calculations, does it mean your return is 13.6%? Now, remember there's a withholding tax here of 10%. So already that is going to eat into that return. Then you have inflation rate at the moment. As at now, we are talking about 4.1. That was as at April. As at May, I think it's gone higher than 4.1%. So it's a tax effective yield of around 15%. Meaning out of that money, your real return is not just around 9.5%, 9.5 to 9.6%. Now, 9.5% as your real return on an investment which is telling you 13%. Tell me in the comment section if you feel comfortable with 9.5% as a return on this particular bond. Going to have it for 20 years. So let's look at the calculator and see. If you are to invest in that bond, you'd be just getting 9.5%. So if you invest 1 million Kenya shillings in this particular bond, you're getting just around 95,000 Kenya shillings. That's a million times 0.095, which is 95,000 Kenya shillings. Let me know in the comment section if that makes sense and if that's something you'd invest in. If you had 1 million Kenya shillings, would you invest? Until next time, I'm out.